This script covers geopolitical events from a purely financial education perspective. It does not take political sides. All statistics are based on historical data and publicly available economic analysis. Viewers are encouraged to consult a certified financial advisor before making any investment decisions. When governments go to war, markets react before the first bullet is fired. Oil prices spike, stock markets drop, gold surges, the dollar moves. And millions of ordinary people watch their portfolios shake without understanding why. The US-Iran conflict has escalated into open confrontation, and whether you follow geopolitics or not, this conflict is already affecting your gas bill, your investment account, and the purchasing power of every dollar you earn. Today, no politics, no sides, just the financial impact. What is happening to your money and what you can do about it? Iran sits at the mouth of the Strait of Hormuz. This one narrow waterway handles approximately 20% of all global oil supply, roughly 17 million barrels per day. Every tanker heading from Saudi Arabia, Iraq, Kuwait, and the UAE passes through this strait. Any credible threat of disruption does not wait for the disruption to happen. Oil markets price in the risk immediately. Historical pattern is clear. During the 1979 Iranian Revolution, oil prices doubled within 12 months. During the 1990 Gulf War, prices spiked 130% in 3 months. During the 2019 Strait of Hormuz tensions, prices jumped 4% in a single day on drone attack news alone. What this means for you right now: every $10 rise in oil per barrel adds approximately 25 cents at the pump. If oil rises from $80 to $120, that is roughly 90 cents to $1.10 more per gallon. For the average American driver, $80 to $120 additional per month in fuel costs. That is before the secondary effects: higher shipping costs, higher food prices, higher energy costs, higher utility bills, higher manufacturing costs, higher prices everywhere. Geopolitical conflict is the stock market's enemy, not because war destroys companies, but because uncertainty paralyzes investors. When conflict erupts, institutional investors, the funds managing trillions of dollars, reduce risk exposure immediately. They sell equities. They move to cash, bonds, and safety. The pattern across modern conflicts: Gulf War 1990. S&P 500 dropped 20% in the first 2 months. September 11th attacks. Market dropped 14% in 1 week. Russia-Ukraine 2022. S&P fell 10% in January alone on escalation fears before the invasion. The key variable is duration and resolution. Short conflicts with clear outcomes, markets typically recover within 3 to 6 months. Prolonged, unresolved conflicts, sustained volatility, energy inflation, and multi-year underperformance in consumer and growth stocks. Sectors most immediately hit: airlines, fuel cost surge; consumer discretionary, spending contracts; tech growth stocks, risk-off selling. Sectors that typically rise: defense contractors, Lockheed, Raytheon, Northrop; energy companies, Exxon, Chevron, ConocoPhillips; gold mining companies, Newmont, Barrick Gold. Oil is the hidden ingredient in almost everything. When oil prices rise due to conflict, the cost increase does not stay in your gas tank. It spreads through the entire economy. The transmission mechanism: higher oil, higher diesel, higher trucking costs, higher costs to move every product from factory to store shelf. A conflict-driven 40% spike in oil historically adds 0.5 to 1.5 percentage points to the consumer price index within 6 months. In practical terms, groceries rise 5 to 12%. Airline tickets rise 15 to 30%. Utilities rise 8 to 20%. Manufacturing goods rise 3 to 8%. The Federal Reserve's response: if oil-driven inflation becomes embedded, the Fed faces a painful choice: raise interest rates to fight inflation, which slows the economy and pressures stocks, or accept higher inflation, which erodes the purchasing power of every dollar you save. Either path costs ordinary Americans money. Not all assets fall in a geopolitical crisis. Some are specifically designed to rise. Gold, the classic fear asset. When uncertainty rises, gold rises. During the 2019 Strait of Hormuz tensions, gold gained 8% in 6 weeks. During Russia-Ukraine 2022, US dollar, the world's reserve currency. In a crisis, global investors flee to the dollar. This seems counterintuitive. The US is involved in the conflict, but the dollar strengthens anyway, because in a global crisis, the US Treasury bond remains the world's most trusted safe haven. A stronger dollar means US imports become cheaper, but US exports become more expensive, hurting American companies that sell overseas. US Treasury bonds. Prices rise as money floods into safety. Yields fall. Mortgage rates, which track Treasury yields, may see some near-term pressure downward, but longer-term inflation risk pushes them higher. This is where financial education separates those who protect wealth from those who panic and lose it. Point 1. Do not make emotional decisions. The market drop you are seeing right now is largely priced in fear, not fundamental damage. Do not sell quality long-term holdings based on news cycle headlines. History shows panic sellers in every conflict regretted it within 12 to 24 months. Point 2. Review your energy exposure. If oil goes to $100 to $120 per barrel, energy sector ETFs like XLE, VDE historically outperform significantly. A small allocation, 5 to 10%, can act as a natural hedge against rising oil. Point 3. Hold or increase gold allocation. Financial advisors typically recommend 5 to 10% portfolio allocation to gold during conflict periods. Gold ETFs like GLD or IAU provide liquid, low-cost exposure without holding physical gold. Point 4. Protect against inflation. Consider TIPS, Treasury Inflation Protected Securities. Their principal adjusts with inflation. Also review I-bonds, currently offering. Commodities ETFs, DJP, PDBC, also perform well in inflationary conflict environments. Point 5. Hold cash reserves. If conflict escalates and markets drop 15 to 20%, that is a buying opportunity in quality assets. Having 10 to 20% in cash positions you to be a buyer when others panic. Patience plus preparation turns conflict into opportunity. Geopolitical conflict is unpredictable. How long this lasts, nobody knows. Whether it escalates further, nobody knows. What the diplomatic resolution looks like, unknown. But here is what is known. Every major geopolitical crisis in history has eventually resolved. Markets have recovered from every single one. The investors who stayed calm, held quality assets, and positioned for opportunity came out ahead every time. The ones who panicked, sold at the bottom, and waited for certainty before re-entering missed the recovery. Your money is a tool. It should not be managed by fear. It should be managed by knowledge. And today, you have more knowledge than you did 7 minutes ago. Review your portfolio. Talk to a financial advisor. Make decisions from clarity, not panic. If this helped you understand what is actually happening to your money, share it and subscribe for more content that turns world events into financial understanding.